All right, guys, welcome back to the channel. Today we're going to find out if RYLD is worth researching. This is the Global X Russell 2000 covered call ETF, and this is 5-Minute DD, the series for those that are new where I do some research on a stock, an ETF, an ETN, and I give you guys the bullet points of what I would want to know before buying it. So I've compiled this list. We're going to jump right into the pros with that 14% dividend yield, a very impressive yield. It usually ranges about 12 to 14%. They say that it's about a 14% yield, and then other places have it ranging about 12 or 13%. I usually use their website data because it typically is the most accurate and usually the most up to date. It is a monthly payer, which I love for those that love monthly dividends. This is a covered call ETF, so almost all the covered call ETFs I know do pay monthly dividends, which is definitely a pro in my opinion because I love the monthly income. I love seeing the dividends going into my account, especially with this market being so volatile and terrible lately. This thing just has been paying out, which I love. Expense ratio 0.60%. Not great, not terrible. I mean, it's average. I guess you could say it's good. It's in the pro section because it's not ruling this covered call ETF out for me particularly. Sometimes the expense ratios, when they get up above 1%, I tend to shy away from those ones. And so this is average, so it's in the pros category. Higher risk, high reward because it's based on the Russell 2000 index. So the Russell 2000 index is typically viewed as being riskier because it is based on small cap stocks. So for those that don't know what a covered call ETF is, they write covered call like option contracts on different indices. They have one for SPY. And so this one's for the Russell 2000 index. So it is just a little bit riskier than I would say with SPY. And that's just my opinion on it. You know, the history could be a little bit different. They are relatively similar. I wouldn't say the Russell's like way riskier than SPY, but it is higher risk category in my brain because it is based on smaller cap stocks, and the small cap market can be a lot more volatile. Typically, it is a lot more volatile. It's never missed a dividend. That's a great thing. The only negative side with that is that it doesn't have a lot of dividend history, so it's not as impressive as a ETF that's been going for 20 plus years. But still, they never missed a dividend. If this thing had a dividend cut in the first 2 years, I would be very hesitant to buy it, but they haven't yet, so we don't have to talk about that one yet. Popular covered call ETF, great for stagnant markets. So I was listening to a couple different podcasts today on the market, and basically people are saying that we're about to head, after the Fed stops with the rate hikes, we are about to head into one of the most stagnant markets that we've seen in a long time. Now, no one can predict the market. Take everything you hear with a grain of salt, no matter who it's from. But if we are in a stagnant market, and I don't see why we wouldn't go into a stagnant market, just based off how everything has been going with the economy and with the wars ongoing currently. So with stagnant markets, these monthly payers are amazing. You're looking at a stock where you're not relying on the price appreciation to bring value to your portfolio. So it is an excellent option in my opinion, because say we trade sideways, or say like over the next 5 years, the market only increases 20%. You are going to have way more money coming in from these ETFs, from monthly dividend payers, you know, REITs, BDCs as well, that are paying out 90% in dividends because they have to continue those dividends if they can. If they cut them, that's one thing. But just on paper, that is one of the better options, in my opinion, when you're going into a stagnant market. But then again, we may not be. So this chart right here is pulled from their investor relations website. We can see their top holdings, which is just all of this. This is all the contracts that they are writing. Insane amount of money. Let's be real with that. I forget if it shows exactly how. I'm sure it does. Net assets, $1.37 billion. So they're working with a lot of money, which is good. Typically, more money means you can make more money, especially if you can yield just an average percent, but you have more money. So that is definitely good in my opinion. It shows that people do. I guess a good amount of people believe in this covered call ETF if there's that much money in it. Let's jump into the cons. But first, we can actually check out this. One of the cons I would say is their dividend, or their chart history. Like I said, the fund inception was 2019. And so big dip in 2020, of course, due to the pandemic. Then ran to 25, which I was loving it up here at 25. I was like, yes, maybe it'll keep going. We've seen the market continue to trail off. So I do own RYLD, I believe. I do own a small amount. And I'm kind of looking to pick up more shares as it dwindles in this 18. If the market continues to fall the next couple months, I wouldn't mind scooping up more shares, especially if this thing runs back to 25. You're going to get a really nice increase on your investment initially while you're also getting those dividends. Not financial advice. That's what I'm thinking about doing. I haven't decided fully yet, but I think this is in my Roth IRA. Small dividend fund history, I talked about that. It's just a little bit riskier because it is a newer fund. So you can't track it like XYLD back 30 years. Low price appreciation, especially, in a bull market, I would not be buying more of this. Just plain and simple, your money is not going to be going up by the price appreciation. I mean, it could a little bit, but that's not the focus of these funds. And I want everyone who's watching to understand that. The focus of these funds is for your dividends. Price appreciation should be the back of your mind, the last thing you think about when you're looking at one of these. If you want price appreciation with dividends, there are options for that, but you typically need to focus on one or the other, or you can go with maybe SCHD, which would kind of be a middle ground, but it only pays a 3.5% dividend yield. So you have to pick what you want exactly, or go with the middle ground, or do what I do and have some of each. That is my favorite thing to do, so that you're getting a little bit of the good and a little bit of the bad with each option. And then you always have some SCHD or a fund similar, ETF similar, to counteract that. And lastly, this is not financial advice, guys. If you found any of this content useful, please do me a huge favor, like the video. It helps me out a ton. Go check out the other videos in the 5-minute DD playlist. I have a bunch in here, and I really love doing these because not only does it help me with my researching capabilities, it also shows other people how they can research and how easy it really is to research this stuff. So if you guys have any questions, feel free to drop a comment. Drop what stock I should do next in the 5-minute DD series. And if you are so inclined, subscribe. That also helped me out a ton. And we've been growing pretty rapidly. We're almost to 50 subs, but I've only been posting on here for a couple of weeks now. So it's a great sign, in my opinion. So I'm going to stop babbling on. I appreciate you guys for watching the video, and I hope you had a great day in the market.